Okay, so good morning, everyone. Welcome to the macro snapshot for Thursday, March the 6th, 2025. Recording this in the morning, just after 7 o'clock. Okay, so obviously the big news in the last sort of day or two has been the announcements, the plans by the Germans to spend up to almost like €1 trillion of infrastructure and defense spending. That's caused a massive and very pretty dramatic and explosive repricing of the European sort of bond yield sort of curve, which has benefited the euro, and also just thrown into question this whole idea of number one, the question that Germany was fiscally responsible and would not overspend. But that now seems to be that Germany has decided that in terms of the realignment geopolitical with less American interests, let's say in Europe, that the Germans will spend a lot of money. And potentially that also means the other European nations, Italy, France, will be more relaxed, spending even more money and having sort of higher deficits. On the other hand, in the US, we do seem to have a divergence that everything which we're trying to interpret coming out of the Trump White House, and it's a bit chaotic and a bit complicated and shifting, is that they do seem definitely to be, reducing the deficit, reducing spending, trying to balance the budget, happy with a bit of unemployment. And even Scott Bessent, the Treasury Secretary, the other day, saying that, essentially they were focusing on Main Street, so maybe not worrying about the stock market too much. So just putting that all together in simple English is to say that the Europeans seem to be sort of fiscally expanding, spending more money, trying to stimulate their economy. The Americans seem to be, if anything, trying to reduce the deficit and reduce spending and sort of cut, so-called government waste. So it looks as though the two economies are, I think it's a little early to say going in opposite directions. And this is going to be the key thing to try and figure out over the next few weeks is Europe actually the economy sort of performing well or better? And is the American economy actually performing worse? And we'll have to look at the hard data because remember that in Germany, this is just an announcement. I was reading some research this morning, a lot of people saying that the flow through, the real effects of this will only really be felt in 2027, 2028 in the German economy. So interesting just to see, if the market pauses. But let's look at some of these moves. Pretty impressive just to show the what's going on and just get a sense of all of this. So this is in the US. The pricing for the SOFR curve, which is the short-term interest rates. And you can see here on the right-hand side, the implied yield. So you see here that what we've got, this is the live data, is a pretty steep kind of cutting cycle going through for the next sort of, 6 to 12 months, reaching a sort of a lower rate in the middle of 2022 of around about 3.75. But really want to look at, guys, let's say, for example, a month ago, and we'll just zoom in here a little bit, and you just see this incredible repricing. So you see in the US, the market over the last few weeks has essentially repriced the implied future yields much lower. So you see, this is where it was a month ago. And you can see that, for example, the terminal rate, the lower terminal rate a month ago was about 3.8%, and now it's down to about 3.55. So that's been reduced quite a lot. So basically, sort of a dovish repricing here on this idea that the Trump administration will be spending less money, be less sort of stimulus, there'll be sort of job cuts causing more unemployment, and basically pushing down potentially inflation with lower energy prices, but also maybe sort of a growth slowdown. So that's the pricing in the short term in Europe. But then if we look, let's say, at the Euribor curve, so this is the 3-month, sort of like an equivalent of the SOFR, but for Europe. And we see this is where we are today. But let's say, for example, compare that to a week ago. And again, I'll just zoom in a little bit. And you can just see the complete opposites happen, that this is where we are in the white line. And you can see that the implied yields for the future has actually sort of been priced upwards, not downwards. In the US, it's gone down 10, 15, 20 basis points. In the Eurozone, for Euribor, it's gone up. So you see, for example, here for December 2025, it looks like we've got, what is that telling us? I think it's about 17 basis points. It's been repriced upwards. So much more. So the idea here is that increased German spending, increased European spending could lead to sort of a stimulus for the economy, economic growth in the GDP, and also potentially inflation risks to the upside. And then finally, just want to have a look at this one, which is kind of, well, not finally, but just, oh my God, what's this device? Hold on, what's this saying? wait an hour. Stupid Windows wants to keep on updating every 2 seconds. Okay, so that's that. But let's what's this one here? Yeah, this is the 30-year yield, the differential between the US and Germany. So you can see here on the top here, this is the US yield, which has gone up a little bit over the last couple of days. This is the daily, but look down here in the bottom right here. This is the German 30-year yield, which has gone up 300 or 400 ticks, or 20 or 30 basis points. And more importantly, you can see the differential here. This is the differential in the lower panel. And you can see that was basically at about 200 basis points, 2.1%, and it's come all the way into about 1.5. So it's come in almost about 50 or 60 basis points, the differential here. So the German yields, really getting much closer to the US yields here. So this sort of exceptionalism of the US story has changed. Another one I want to share with you, which is pretty interesting, is also just to notice here, if you look at, let's say, something like the December 25 contracts for the US and for Germany. And again, you can see the yield difference has come in, or the difference has come in sort of radically here. So this is the implied yield. And you see here, the white line on the top is for the US, so the SOFR contracts. And you can see here that the implied yield's gone from 4 down to, let's say, about 3.66 or so. So that's come in basically a lot. That yield has come down. And whereas you see in Germany for the Euribor December 25, you see how it's gone up quite a lot, and therefore the differential. So putting that all together, basically what we're getting here is a divergence in potentially monetary policy. And if we look here at the US, we can see that by December of 2025, we're expecting the market's pricing in here about 71 basis points. So that's just under three cuts. You see here 2.85 cuts, and that's been repriced, more or less sort of dovishly over the last sort of a few days. And I'm just going to put in here a intraday. So we'll just have to see how that's been repriced. And again, that's the intraday. So I'm going to have to just sort of scroll back a little bit here and just show you. So if we go back, and again, I'm just going to have to scroll back as much as I can. Maybe intraday wasn't the best thing. Yeah, that's a little bit better. So what we can see here, this is showing the pricing, what the market is pricing in for December in terms of the amount of basis points to be cut. And remember that 25 basis points is one cut. So if you go back to, let's say, the 21st of February here, we're at about 40 basis points of cuts. And as you guys can see, it's kind of just drifted down over the last 10, 15 days. Again, based on this idea that the US will be slowing down. Whereas if we actually look here at the Europeans, we can see here that that's now priced in for 2.7 cuts. So pretty similar, but at about 69 basis points. But again, if we can look and just see what's happening. Now, keep in mind that the American one, it's been priced down more dovishly. But if we actually look at what's been going on in Europe, and it's a bit choppier because we have overnight gaps. But the bottom line here is that if you look for the December pricing, you can see in Europe that that's been priced up quite a lot. And so the market's taken out, quite a lot of cuts there. And if we actually just go back to the chart and we look at, let's say it's 69 basis points now. And let's say we go back, let's say a week or so, we can go back to, I don't know, let's say last Thursday. It was you could see it was 86. So that's pretty incredible. We've gone from 86 to 69, I think it is. So 86, yeah, to 69, which is, what's that, 17 basis points. So almost a full cut, about 2/3 of a cut has been taken out. So that, of course, leads us to what's going on in the markets. And today we, of course, have the ECB coming up in about an hour or so. So they are expected to cut 25 basis points, but really what's going to be very interesting is going to be the forward guidance, because at this point, we've seen, for example, like this is the 10-year yield in the Bund. And just while we've got that up, let's just try and see where we're getting to. We're getting to points where, it's gapped up pretty explosively in the last couple of nights in the overnight session. And we're getting maybe towards a bit of a resistance point, but certainly this 3% level looks like it's a nice overhead resistance. So in terms of what Christine Lagarde says today in about an hour or so, it's going to be very interesting. And I think the market is expecting a 25 basis point cut, but really what the market wants to see is how she reacts to this this very, very powerful move upwards in the yields of the last couple of days. And some people say it's been the biggest move in the yield since German reunification back in 1990. So will Lagarde sort of acknowledge that and just say, okay, the situation has changed a little bit. There's going to be a lot more spending on infrastructure, on defense. There are now upside risks to inflation, and therefore, essentially, will she potentially signal, possibly, the potential at least for a pause in the next meeting in April, I believe it is, which at the moment is priced at about 50-50. So, or will she actually say, no, no, we definitely have to be a little bit more hawkish? So one way of interpreting that will be the use of the word restrictive. The commentators, a lot of commentators have thought that, as they have cut, they would drop the word restrictive. So remember that up to now, the ECB in their policy statements have been saying every time for the last, I don't know, year or so, they believe the policy is restrictive. Okay, so if they believe the policy is restrictive, that means there's potential to cut more because it's still a little bit too restrictive. So the idea now is that maybe if they don't mention that or remove the word restrictive, the policy is restrictive from their policy statement, that will indicate a slightly hawkish tilt to say, well, hey, even at these levels, it's not really restrictive because the risks to inflation are to the upside. I think also the press conferences, it could be potentially, normally with Lagarde, it's extraordinarily, how can I say, boring. But today could be quite interesting because these are relatively recent developments, what's been happening in Germany. And so it'll be interesting to see what she says there. Now, just in terms of the trading, it's interesting because, it's tempting to chase here, but you've got to say at this point, the yields have gone up enormously. Might be time just to have a little break here. We've seen also a very powerful steepening in the German curve, so 230s. We've seen how much of that's steepened up. We've got a big overhead resistance here at 1.137. That's still, what is that, 20 basis points away. But we did see that, 2 or 3 years ago. So that's possible. Maybe you could take a pause, but we could definitely get a little bit more steepening. What's also interesting is to look at some of the differentials. We saw yesterday that the German 10-year yield went up 30 basis points. But to be honest, the Italian yield also went up. So if we just look at the Italian outright yield here, we can see that the Italian yield also went up a huge amount. So therefore, the spreads didn't actually go out that much. I mean, we're seeing a bit of action here today, but the spreads have been relatively stable. And that's because the German yields are going up, but also the Italian yields and the French yields are going up. So at what point, I mean, it's going to be very interesting now, also in terms of the euro, in terms of the FX, is will the bond vigilantes, so the bond market say, well, okay, at what point does this extra spending become sort of good news and a stimulus for the German and the European economies? And at what point, if ever, what is the tipping point where the market starts to say, hey, these governments are running out of fiscal headroom, out of fiscal space. They're actually spending too much, and this is going to start creating a sort of a problem for national budgets. You see, the point is it's nice to borrow money and have deficit spending and stimulate, but at what point will the bond vigilantes come in and say, whoa, that's enough. This actually is getting out of control. And I think if that were to happen, we're going to see two things. I think you're going to see the yield spike even more in Germany, but I think we could start seeing a little bit of upward pressure on this Italian-German spread as it becomes clear that countries like, let's say, Spain, Portugal, Italy, who haven't been fiscally prudent like Germany has. Remember that Germany has been very fiscally conservative for the last 10 or 20 years. So one could argue that they actually can, quote unquote, afford to loosen the belt a little bit and spend a little bit. But countries like Italy, Spain, Portugal cannot, especially Italy, with 140% debt to GDP ratio. And so I just wonder at what point the market stops relaxing and say, okay, this needs to be reflected in the spread. And again, as I like to show you guys, this spread is at very low historical levels. I mean, when I sort of normally or often historically, it's been at, 1.3, 1.5, 1.7 up to 2. So at the moment, just over 1%, 107 basis points, it's very low. So my gut feeling, just a gut feeling, is that at some point, if this spending continues, this is going to start to be reflected in the yields. Of course, it's in the spread. It's got to be tricky to time that, but that's sort of my feeling. The other thing, of course, which we need to be looking at is the euro. Now we know that the euro USD has had a huge run up. It's now at about 108. Where are we? Let me just find it. Here we go. So as we speak this morning, this is on the daily chart, and you can see here there had been some rumors coming out on this first on sort of Monday the 3rd, even over the weekend, going back to the weekend at the end of February here, beginning of March. But then that announcement came. And keep in mind, this isn't law yet. It still has to be passed into law. And then we had this pretty explosive move upwards. But at this point, it's sort of interesting because we're now at a 61.8 fib retracement, which is this orange. So this is going back to here. You see here in the 27th of February. So potentially now there's a bit of horizontal resistance. There's a fib retracement level. So the question is that it? I don't know, to be honest. Could we see a little bit of retracement? Absolutely. And then go higher? Or is this it? Or will this continue going? I mean, we basically have two important risk events. We have the ECB coming up this morning. Now, if they're hawkish and Lagarde says, whoa, 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 not so many cuts, and we are, we have slightly altered our opinion about inflation risks, and maybe now inflation risks are to the upside. There's no reason potentially why the euro can't just keep on popping up, at least to, let's say, I don't know, maybe this 109.40 level, which would be the next pretty key level, because we're well above all the moving averages now. Now, of course, it's oversold on the RSI, on the Bollinger Bands, it's overextended, but this can keep on going. But sort of quite interesting. The other one I'm looking at is also Euro JPY, which again has come to sort of pretty interesting horizontal level here. That's given back a little bit today, so that's sort of interesting that the Euro JPY is giving back a little. Definitely in terms of sort of momentum and stochastics, the euro is overbought. We'll see. Let's see what happens to the ECB. And of course, the second risk event I was referring to was the US in the non-farm payrolls. So if we actually look at the US dollar, of course, that's been very, very weak. And again, it's just what I was saying earlier, is this whole question of US exceptionalism has been sort of turned around essentially. And we're starting to see this idea of that maybe the European market or the European economy is going to start outperforming the US economy. And you can see that in things like the surprise indexes, which I've got here, which I will endeavor to bring up. So the surprise indexes are this idea of if the economic data is outperforming or underperforming expectations. And this is from Citi. So if you look here at the surprise index for the US, which I'll just bring up. Excuse me, just having my tea. You can see here that essentially it's sort of since November. I mean, it's a bit of it's quite a complex framework. But if you see here since November, it seems to have been the peak. And you see here that basically what this is saying is that since November, and then coming into January and February, in general, this index looks at many, many different sort of data points and basically says, compared to consensus and expectations, how does the actual result come in? And what we can see is that the surprise index is actually pushing down in the US. So that's basically saying that in general, the data is coming in weaker than expected, which of course is not good. And we saw yesterday, for example, ADP numbers, the private payrolls came in at 77,000, much lower than expectations. Now, there was something yesterday. We had the ISM services, which came in a little bit higher than expected. So pretty good employment numbers, pretty good new orders, and the headline number was good. So the point is here is that with the exception of ISM services, the data has slowly started to weaken, and certainly it's coming in lower than expectations. On the other hand, if we now look at the equivalent one, you see here the surprise index for the Eurozone. Let's have a look at that. Aha, very interesting. We can see that for the Eurozone, it's a choppy number, but it does seem as though the surprise index for the Eurozone actually is going in the other direction, which means that the results are actually a little bit better than consensus or expectations. So these two charts, I mean, that's not the final word, but they are giving some sort of sense that the US maybe is slowing a little bit, or at least expectations are slowing on Trump's policies, and that in Europe, of course, maybe it's the converse. So what does that mean? That means that, obviously we've seen the yield differential, so the US dollar or the dollar index, which is 58%, euro, of course, that's sold off pretty hard. So it was sliding. Then the last 3 days, basically with that, as I say, 58% constituted of by the euros, the DXX, DXY. But now we're getting to an interesting point. You can see here the big fib level going all the way back to, let's say, the 1st of October. It's broken through the 38, the 50%, and that's now at horizontal resistance here. And kind of, well, I should say support down here, which is the 61.8% fib retracement. So we are definitely getting to a point where the market potentially at least um, will think about, some kind of sort of change here. It's blown through all the moving averages, as you can see. So this is sort of the final thing. If we get a hawkish ECB today, and we get weak non-farm payroll numbers, which reflect, let's say, the ADP, it could be that this dollar index, to be honest, goes down further. And then if we look at the USD, Japanese yen, a similar kind of breakdown. It was holding, remember, we were talking about this level here at the 50% fib at about 149.30. That held for a few days, bounced a little bit, but that has now subsequently broken, and it looks as though it's going down to test this other, again, another 61.8 fib level. It's broken down through all the moving averages. All of the moving averages are pointing downwards, the moving downwards. So this is not looking good for the USD JPY. And you've got to say that, next stop is probably down to 147. And who knows, maybe a little bit more. Politically as well, this suits the Japanese government. A stronger yen versus the US dollar is what the Trump administration wants. So if the yen strengthens, that will take some pressure off the Trump administration to put pressure, tariff pressure on the Japanese. So politically, the point I'm trying to say is that I don't think the Japanese are in any hurry to stop this appreciation of the yen. The other interesting thing, just quickly, is that with Canada, I see the US dollar coming back a little bit, although it did fall off a little bit, just because I'm not going to go into the details. It's annoying and tedious. But essentially, yesterday the US what is it called, the USA Mexico CA USMCA agreement, which is the old NAFTA free trade agreement, basically saying that car companies could be exempted for a month just to get their supply chains reorganized. So the market took this as a little bit of a positive for the Canadian dollar, essentially saying, hey, maybe the tariffs are being reduced a little bit. And you can see here, there was a little bit of a pop on the Canadian dollar that's subsequently sort of come back over the last 3 or 4 or 5 trading hours. But the point is that the US dollar overall is weak. And the confusion caused by the Trump administration's policies, and also the idea, the sort of the recognition or the hypothesis that they're going to be as bad for growth, is really what's driving the market. So I think let's see what happens with the ECB and the non-farm payrolls. I mean, that's also being this lack of growth. Just quickly looking at something like oil here. We can see that oil is sort of going down, just looking at the April contract, testing these lows, which we thought it would. Remember, yesterday I was saying that, taking out some stops here. Now, I think that's probably, not a bad buying area, but, there's still a lot of pessimism about global growth and US growth. And so maybe oil, rather than bouncing viciously or strongly, it would not seem, for me, my sort of feeling here is that there's no reason for this to collapse massively, because the markets are still relatively well balanced, and the OPEC production increases are actually quite modest, about 138,000 barrels a day to start with. But symbolically, that has some importance. But my point is here is that's kind of, has triggered a few stops down here. Wouldn't surprise me to see oil here just trading pretty quietly between, let's say, $66 up to maybe 70, just in a pretty tight little range there, until and unless we get sort of, more clarity about what's happening in Europe, but especially in the US. Now, of course, just with stocks, we've seen, if we just go over look in Germany, obviously the German, the DAX index, the German index loved that stimulus thing, but now kind of it's been, to be honest, it's been going up a lot since the beginning of the year, maybe starting to look a bit overextended. The same here for the Euro Stoxx 50. Starting to find, I don't want to say overhead resistance here, but just losing a little bit of momentum here up at the highs. And maybe, a lot of this sort of stimulus news and the exceptionalism story, or the outperformance story of Europe is starting to lose a little bit of energy. And I was just reading a note from Goldman Sachs this morning from their trading desk, sort of essentially just saying, whoa, let's all just sort of pause and reconsider here. And again, at a certain point, if bond yields continue to ramp up too much higher in the Eurozone, at a certain point, this is not great news for the equities who don't like these very high levels of bond yields. Okay, guys, I'm going to leave it there, but let's just quickly, apart from the ECB coming up fairly shortly, in about an hour or so, let's just look at the data. We do have some data coming out of the US here. We have the jobs report, the initial jobless claims. Now, remember last week that was a little higher than expected. Will we start to get some of the effects of the layoffs from the Doge, in Washington, D.C., government workers? Will we start to get an extra 10, 15, 20,000? That could get the market's attention if this number for the initial jobless claims comes in at, let's say, 240, 250, because that would start to indicate some kind of pattern of, slightly higher initial jobless claims, indicating that the U.S. employers announced most job cuts since 2020. What's this? This looks like some kind of new headline coming out here. So we've got that. We also get, what else do we get this morning? We get, I think that was the trade balance. Yeah, the trade balance is interesting. Normally a number which the market doesn't particularly overly worry about. But in view of the tariffs and Trump's obsession with the trade balance and whatnot, the trade balance here coming in could be interesting just to see. You see here it's meant to be a negative deficit here of 128 billion, much more than last time, which was 98 billion. And again, there was some talk that the reason for this is because a lot of people and companies were front-running potential tariffs, so they put in a lot of orders to import stuff in the US before tariffs were placed on them. But if this number is sort of, at here or even maybe 130, 140, that's not going to be good because the Trump administration will be looking at this number and saying, aha, you see, this is evidence of a trade imbalance and a trade deficit, which of course potentially could be more of a justification for imposing more tariffs. I'll leave it there, guys. As I say, let's see what Lagarde says with the ECB. If she's hawkish, there could be more upside room for European yields to keep on going up and for the euro to keep on going up. And again, we have to put that in context with what happens with the initial jobless claims and, of course, the big one tomorrow, non-farm payrolls, just to see if this idea that the US economy actually is slowing down and unemployment is gaining will give more sort of fuel to this sort of divergence story, which seems to be the main thing. Okay, take care and have a wonderful day. Thank you.